Hello and welcome to today's video. The topic for today is around passive cash flow. A very interesting conversation that people love to have is where to get passive cash flow. So today we're going to take a look at private lending versus Coca Cola stock and do a passive cash flow comparison. Now, let me explain how this video came about today. Last week, I saw this article right here on yahoo.com, and it said, that's the title of the article right there, how much Coca Cola stock would you need in order to generate $100 in passive income? I was really curious, so I read the article, and the details of that were quite interesting. And so I'm going to jump into that here and see what this comparison looks like. So let's take a look at some sources of passive income and ask the question, when do I need to have passive income? So many people are working to grow an investment account, and growing is really important and getting compound growth. But at some point, when you want to start living off of the income that portfolio or investment account can produce, you do have to shift away from just owning assets for growth and have some assets that create income so that you don't spend down your principal and you have perpetual passive income. And so with that in mind, people are always on the lookout for what are good sources of passive income. Some of the well-known ones are dividend paying stocks, and we're going to use those as part of a comparison today. Bonds are really well known. Coupon bonds are the ones that pay you on a regular basis. Rental property income, that would be definitely that others manage. If it's going to be passive, it wouldn't be you managing it. And owning a business for cash flow, one that runs without you. Again, it has to run without you in order to be passive. So those are more well known. Some that may not be as well known are private lending. That's what our business does and what we are experts in. So we're very familiar with that one. And there's others like royalties. A couple of different categories there. Royalties from things that you produce, like songs or books, things that you get patented, digital content that you create, and then royalties from things that you invest in, like oil, gas, or minerals. So these can all be ways to get passive income when you're ready for that. So let's talk about today's topic, which is going to be dividends versus private lending. And in this article from Yahoo that I mentioned earlier, they use this term dividend aristocrat. So what is that? Because Coca-Cola is one of those, we should ask the question, what does that mean? Well, to qualify for that status, a company must be in good standing in the S&P 500 and must have increased its dividend payment for 25 years. That's a long time. And in fact, the article says that Coca-Cola far exceeds that. So they're like a well-established dividend aristocrat. So they must be paying out pretty good. Let's look at this comparison here between this Coca-Cola stock and private lending. So dividend, that's going to vary somewhat with the company profits. And in this case, the article says it gets paid out quarterly if those targets are hit. And the article also says that it's currently paying out 3.08%. So that's what a Coca-Cola stock is offering. What about private lending? Well, the rates here are set, and the distribution timing is as well with many private lending companies, and it's the way we do it here. It's going to be on a monthly distribution basis. So in ways that would be a little bit more like a high-paying bond than a dividend stock, because with a bond, you know upfront exactly what payments to expect and what frequency, and it's just that with a bond, it's really hard to find a highly rated bond that's paying a very high percent. You might be looking at even less than this 3.08 from Coca-Cola. But currently, private lending could be paying somewhere around 9%. I know that's what we're paying out here at our company. Other private lenders may be paying out a similar amount. So 9% to 3%. Let's see what that looks like when you apply that to real numbers and over time. So In that article, and again, the article is right here. If you want to look at it, I encourage you to look at that and read it for yourself. An interesting article. So what we're going to compare here is the dividend aristocrat method versus the private lending method. And we're going to start with a 1-year analysis. And look, hey, there's a lot of numbers on the screen, but you don't have to worry about all of these. The main thing is the first number and the last number in each of these boxes. So why did I pick 40,446? Well, that's the number that this article said you would need to own in Coca Cola shares in order to get $100 a month in passive income. So if you look at that over a 1-year period, if you let that build up and just took out one distribution at the end of the year, you would have gotten $1,263 at this 3.08%, assuming it's working 100% of the time. Here, starting with the same amount with private lending, but at a 9% rate and 95% efficiency. So that means the funds are working 345 out of 365 days a year. With private lending, there can be some downtime in a year. So very often, private lenders are doing 6-month or 9-month loans. We do 9-month loans here. And so in between loans, when one gets paid off and the next one gets started, there is a little bit of downtime. So very conservative to say 95% efficiency here. So if you started with the same amount and you let it grow over the year and you took the cash flow at the end of the year, you're looking at $3,578 compared to $1,263. It's a pretty strong difference there for something that can be conservative compared to something that's also known as a little more conservative and blue chip. But a 1-year analysis, same investment, and you see a 3,500 return versus a 1,200 return roughly. So let's take a look at what that would be over 10 years. So all the other factors here are the same except for the loan period. So we're looking at 10 years instead of 12 months here. So same amount initially invested as the last scenario. If you let it compound and you take it out at the end of 10 years, you're getting a 14,334 return. Over here, we're really starting to see the effects of that compounding growth. In fact, we see at year 9, the initial amount has doubled if you're letting things compound over time here. And then at the end, if you wait until the end of 10 years and you pull out your cash flow, over $51,000. So a very, very significant difference here between private lending and the dividend aristocrat method. So that's one amount. Let's take a look at the same kind of comparison with 100,000 start, because many people aren't starting with 44,000. They're starting with higher amounts. So let's take a look at the 1-year analysis on 100,000 with these two. So for 1 year, if you put in 100,000, you let it compound, you've gotten $3,124 of cash flow in a year. With private lending, you're getting $8,846. So again, just in that 12 months, a very significant, more than double cash flow there on a 1-year analysis. Now, final numbers. Again, some people love numbers. Some people get a little bit bored. That's why I'm saying just focus on the entry number and the exit number. And you can see, if you are a numbers person, you can see the math in between. But again, what does the 10-year look like with a $100,000 initial amount? So here with the dividend aristocrat method, 35,000 growth over 10-year period. That's pretty nice. With private lending, $126,000 growth over a 10-year period if you cash out there. So again, double the money in 9 years, and very nice cash flow. Very significant. 126,000 compared to 35,000. I don't know about you, but that shows me why I'm more of a fan of the private lending method for passive cash flow than the dividend aristocrat method. So in summary, some people out there just love the stock market, and it's their thing. And so I don't try to talk people out of the stock market if they love it. If that's where they want to be, fantastic. But some people don't really like the volatility of the stock market, and they prefer some other options. And if you want to have passive cash flow at the end of the day, you have to look at the options that you have available for that. So for a pure passive income solution, we can see in the numbers here, private lending is a very attractive option. And here's one of the houses that's a finished remodel that our company financed. And it's in the Birmingham, Alabama area. In fact, a suburb called Bessemer, Alabama. So we love the fact that when we do private lending investments, they work to improve the local economy and the local housing. So one of the things that we love about private lending, other than the fact that it's a great passive income solution. So as we wrap up, just remember, sharing is caring. A lot of people have never heard of private lending. They're not familiar with it. They know some of those other primarily known ways of passive income, and they don't know some of the ones that are under the radar. So it can make a difference. And we are still growing. Very busy here in the summer of 2024. We're growing. Sometimes we have more projects and funds available. So if co-lending is something you're interested in, reach out, and we'd be glad to share with you what we do as private lenders. So that's it for this video. We're glad at REI Funding Partners to be providing fresh, attractive housing in the Southeast, one co-lender at a time. Until next time, take care and God bless.